Hey, welcome to the world of finance. And in these sections, we're going to be talking about like mortgage finance and these types of topics, very popular on examinations. So you definitely want to do a fine-tooth comb here. There's a lot of vocab phrases that you will see. Not as much math, right? And not as much math calculations. You might see calculating interest only and those types of things, but not heavily mathematical. It's more or less terms, topics, vocab phrases, and concepts. All right, so good luck with these. The first one that I want to cover in this module is what is an amortized loan? So we want to know the difference between full amortization and partial amortization. The word amortization is a type of loan where the borrower makes regular payments that cover both the interest and a portion of the principal balance, reducing the amount owed over time. So if something is amortizing, we are eliminating principal and paying interest, which is the charge for using the lender's money, which is the principal balance of the loan, the original amount that we borrow. The monthly payment remains constant throughout the loan term, but the portion allocated to interest decreases over time, while the portion allocated towards the principal gradually increases. Now, gradually, this process reduces the overall loan balance until the loan is fully repaid. So a fully amortizing loan will retire the entire balance on a certain date, like a 30-year fixed rate, fully amortizing mortgage loan. Okay, what is a partially amortized loan? In the previous module, we just looked at what is full amortization. Partial amortization, classically on exams, you'll see as a balloon mortgage. So that'll be the trigger. You want to know what a balloon loan is. All right, a partially amortizing loan is a type of loan in which regular payments do not fully repay the principal by the end of the loan term, requiring a large lump sum payment for the remaining balance. This large payment at the end of the partially amortized loan is typically called the balloon payment. So you want to connect the word balloon mortgage or balloon payment with a partially amortized loan. And another thing that you want to know about a balloon mortgage is that it is a risky loan feature to have a balloon in a mortgage. So that also could be one of the questions that the test writer asks, is about it being a risky loan feature. Okay, compared to a fixed rate, fully amortized 30-year mortgage. Interest-only mortgages are a situation where a type of loan where the borrower is only required to pay the interest on the loan for a specified period, typically for the initial part of the loan term, after which they must begin repaying both the principal and the interest. In real estate, interest-only loans are most often seen in second mortgages. For example, you might see it on a second mortgage, IO or interest-only, or in what they call a HELOC, a home equity line of credit. So a line of credit is generating interest. There's interest on the amount that you borrow, and then the principal has to be paid back upon at some period. Also, interest-only mortgages would be considered, and many of it's a riskier loan feature compared to a fully fixed rate amortizing loan, full amortization versus interest only. What is the Truth in Lending Act? Number one, it's a piece of legislation that protects consumers, so consumer protection, and it is in the mortgage financing sector of the real estate business. Okay. It's called TILA many times in books and on exams. So instead of Truth in Lending Act, it's a piece of legislation, it might be called TILA. Also, many times is referred to as Regulation Z. So you want to know Truth in Lending Act equals TILA equals Reg Z. Regulation Z. All right. The Truth in Lending Act is a federal law designed to protect consumers in credit transactions by requiring clear and transparent disclosure of terms and costs associated with borrowing. One of the terms that you will see in this section is what is APR, which stands for annual percentage rate. All right, what is it? APR represents the yearly cost of borrowing, including both interest and any fees expressed as a percentage. It allows consumers to compare the costs of a loan from different lenders. Advertising guidelines are another big component of the Truth in Lending Act. So when we're dealing with truth in lending, we're also dealing with advertising. All right. Advertising guidelines. TILA sets guidelines for how lenders must advertise credit terms to consumers to ensure that they have a clear and accurate information when considering borrowing options. Advertisements for credit products must include certain key details, such as listing the APR, any applicable fees, and any repayment terms. And these terms must be clear and conspicuous, and no bait and switch advertising is allowed. And you want to know that the Truth in Lending Act covers all of these particular items. And it also has one more thing that you many times see on exams, is the Truth in Lending Act mandates something called a 3-day right of rescission for any time we are refinancing certain types of loans. And you'll learn more about the 3-day right of rescission in another module. Continuing on about the Truth in Lending Act, let's talk also a little bit about what are finance charges. So finance charges encompass the total cost of credit, including interest and fees associated with taking out a loan. TILA requires lenders to disclose any finance charges to borrowers before they enter into a loan agreement to give them the ability to understand the true cost of borrowing so they can make informed decisions. Regulation Z provides detailed rules and requirements for lenders to comply with the Truth in Lending Act, including disclosure requirements, advertising standards, and protections for consumers. TILA and Regulation Z are designed to protect borrowers from unfair or misleading lending practices. So the Truth in Lending Act is an important one that you see a couple of different components. Don't forget APR. Finance charges. It's called Regulation Z, deals with disclosures, deals with financial advertising and its truthfulness to a consumer, and it's a consumer protection law. Many times on exams in mortgage finance, they might want you to have a quick, simple rundown of what are risky loan features. And these are important to this might be a multiple choice scenario where it's like all of the following are risky loan features except kind of things, right? So we know that a fully amortizing fixed rate mortgage loan is completely acceptable, but there are certain features that are considered risky. For example, prepayment penalties are considered risky. These are penalties for the early repayment of a loan. Adjustable interest rates. Adjustable rates versus a fixed rate mortgage loan, where the fixed rate is the rate over the long term of the loan, but the adjustable rate mortgage is keyed to an index and it's fluctuating based on the market dynamics of the current time, and it adjusts either up or down. So adjustable rate mortgages can be a risky loan feature, more risky compared to a fixed rate, predictably understanding where the rate's going to be fixed rate loan. Interest only loans we talked about in a previous module. Interest only is a risky feature, and the fact that we are not reducing or retiring any principal balance necessarily in the initial gestation periods of a loan, giving only interest back to the lender, not principal reduction over time, thus kind of making it a risky loan feature. And any balloon payments. Anytime you see the word balloon, understand that it's a partially amortized loan. And you also want to know that those are risky loan features anytime that there is a balloon of principal owed at the end of any term.